Would you like to be a better investor? Of course you would. Well, in order to be the best investor that you can be, it's just as important to avoid mistakes as it is to find good opportunities. I used to coach basketball, and as a basketball coach, one of the things that you teach your players is that if we're going to try to score as many points as possible, we need to A, get good quality shots every time down the floor, but B, we have to limit turnovers. Every time the other team steals the ball, or we travel, or we commit a foul, we're losing another chance to score the ball. If you can lower the number of turnovers you have per game by 5, that's 5 more chances to score the basketball. And when it comes to investing, avoiding mistakes can be just as valuable as finding those good opportunities. And one of the most common types of mistakes that's out there is confusing correlation with causation. And this is really just a fascinating aspect of investing to me. One of the hardest things to do as an investor is trying to connect all of these dots between all the things that are happening. The price of oil and interest rates and tax rates and GDP growth and the S&P 500 performance and national debt and consumer spending and new developments in technology. There's just a million things happening right now. And what we try to do just naturally as human beings is we try to find explanations for why those things are happening the way that they are right now. And why are things happening simultaneously? And sometimes the reasons may seem obvious. Well, gas prices are higher, therefore people are not traveling as much this summer for vacation. Or government stimulus checks went out, and now the average savings account balance is higher. But sometimes it's not nearly that easy. And many times what we're actually trying to do is connect dots that don't need to be connected. There are sometimes 2 things or 3 or 4 different things that are happening, and we're looking for a way, how are they all related? How do they all go together? And very often there may be a plausible explanation for how they're related to each other, but that may not mean that that is the case or the true reason. Back in the 1970s and 80s, there was an increasing number of studies that were showing that there was a link between mouthwash and cancer, particularly mouth cancer, throat cancer. Clearly, the numbers are showing that people who use mouthwash are much more likely to be diagnosed with cancer. And so the alarm went out. Don't use mouthwash. It causes cancer. Obviously, it would make sense, right? If mouthwash contains alcohol, you're using this product all the time in your mouth, can get into your throat, that could have an adverse effect on your health, right? And lead to cancer. The only problem was that after more careful consideration of the data, researchers found that these studies weren't adjusting for other confounding factors. In other words, they weren't looking at whether the people who were using mouthwash were also more likely to engage in other behaviors, like or have other health concerns. So, as it turns out, the people that were using mouthwash more regularly, a higher percentage of them were drinkers or smokers, which is why they were using mouthwash more frequently. And when they adjusted the data for that info, it turns out that there is no increased risk of cancer from mouthwash. There's no correlation there, no causation. The reason people were using, the reason that there was more cancer was the people who were using the mouthwash were themselves already more likely to contract cancer because of their other unhealthy habits. So it's a wonderful example and a long line of examples that we could go into that shows that correlation doesn't always equal causation. And we understand this intuitively. Just because things are correlated and go together doesn't necessarily mean that one caused the other. So for instance, there's a funny one in investing. The stock market has done better in years when the NFC wins the Super Bowl instead of the AFC. But if I came to you and said, hey, good news, the NFC team won the Super Bowl this year, so we're much more likely to have a good year in the market. So I think now is a great time to invest. You would wisely say, I think we need to find a new financial planner. That doesn't sound like good advice because correlation does not equal causation. We could look at all kinds of silly comparisons that are true, but they don't have anything to do with each other. And there's a whole website out there. I think it's called Spurious. Now I'm forgetting it. Spurious Connections. So for instance, the amount of honey produced by bees each year and the number of people who drowned, it's like staggeringly close, like the plot chart of those two sets of data. Or the increase in money that we spend on pets each year and it coincides with the number of people who died by falling downstairs. They kind of go in lockstep with each other. Or the price of oil in Saudi Arabia and the price of bananas for many years seem to be very closely correlated. Now, you could try to find some link between those two pieces of information and why they're moving in tandem, but a reason really doesn't exist. It's just pure coincidence. There is no causation there. And on top of that, sometimes we even mix up the direction in which causation is flowing. So we look at two things that go together, but we think one is causing the other and not the other way around. So, for instance, you might say, hey, I've noticed that the more firefighters are sent to a fire, the bigger that fire tends to be. Aha! I see what's happening. More firefighters are causing the fires to grow. We should send fewer firefighters to respond, then the fires won't grow as big. Well, of course, that's not the case. Bigger fires cause more firefighters to be sent and not the other way around. So let me just give you 5 real ways in the realm of investing that we can get ourselves into trouble by trying to find connections that don't actually exist. One is probably the most obvious one, assuming that a stock's past performance is a guarantee of its future return. In fact, you see this disclaimer all the time in various advertisements about investing. Past performance is not a guarantee of future results. So hey, stock ABC over here, it's been up 30% a year for the last 5 years. This is a great investment. We should buy some. But a rising stock price doesn't necessarily mean that the company is going to continue to grow, and certainly not going to continue to grow at that same level. The rise could be due to a myriad of factors. It could be that there were low interest rates. It could be that there was industry hype. It could be that there was government incentives. It could be a lot of things going on underneath the surface rather than true financial strength of that company. So to give you a more recent example here, you see what's happened with Tesla stock here recently. Tesla stock had an amazing run for several years starting in 2020, but it was for many different reasons. It was because of the future earnings and revenue growth expectations that Tesla was going to dominate the electric vehicle market, what they are working on as it relates to autonomous vehicles. So a lot of the price was being driven by investors' future expectations of what Tesla was going to be doing, not its current financial state or current production. But many people bought it, assuming that those returns are just going to continue indefinitely. And if you bought Tesla stock a few months ago, you'd be very, very disappointed with its results because it's dropped quite a bit here recently. So it's a good example of, okay, just because a company has been on fire recently doesn't necessarily mean that you're just going to be able to continue to see that on a consistent basis. But secondly, a lot of times investors do that the other way around, though. They're like, oh yeah, I would never be such a chump to say, oh, well, let me just buy the hottest stock because I know that that's not a good idea. I know that, it's probably maybe overvalued or it's had its good run. It's not going to continue. But they'll do this the other way around. They'll assume that a stock's past underperformance means that it's due for a rebound. So instead of trying to find the best performing stocks, they'll look for stocks that have done poorly recently. And then they'll buy it thinking that, of course, any day now, it's going to turn around and we'll capitalize big on it. Because if it was worth, $50 a share 2 years ago, and look at it, it's down to $20 a share now, certainly it's going to go back up to 50, so I'm going to buy it now. In investing, we call this trying to catch a falling knife. Buying companies that have fallen precipitously in recent years. And the reason this is so dangerous is because predicting the bottom for a stock price is very difficult. Just like predicting the top, the all-time high of a stock can be very, very difficult. And it brings up some questions about, okay, well, what if you buy this stock at a price that you thought was low and it continues to fall and now it's down to $15 a share, $10 a share? Do you continue to hold it for the rebound, or do you say, I'm just going to cut my losses and go ahead and part with this stock? Many falling knives never recover, or at least they take a very long time to do so, much slower than the rest of the market, and many of them close altogether. And a lot of people have gotten themselves in a world of hurt trying to capitalize on this idea of, oh, okay, well, if a stock price has fallen recently, it will rebound here soon. Not always. Number 3, buying a stock because an expert also bought it. And I use expert as a very loose term. There are some true experts like the Warren Buffetts of the world, and then there are many so-called experts, people that you find on TikTok or on Instagram that are constantly throwing out their latest picks. So be very careful about that. But just because somebody, even a very respected somebody, bought a stock doesn't necessarily mean that that makes it a great choice for you. A lot of people will do just that. They'll look at Warren Buffett or other famous investors and they'll look and see, okay, what stocks do they own? And I'm just going to buy theirs. And the reason this is not a good idea, well, several reasons why this is not always a good idea. First of all, they can have different reasons for investing, a different time horizon. They may have some type of insider knowledge or long-term strategies or even hedges in place so that you as a retail investor wouldn't be able to see. But also, these guys get it wrong plenty of times too. People followed Warren Buffett into IBM stock in the 2010s, and that didn't work out great. Buffett, of course, later admitted it was a mistake. He's made mistakes before. He's had a lot of great picks, and he's had several bad picks. You add to that ConocoPhillips and US Air and several others. So just because somebody else bought it is not a good enough reason for you to say, well, I don't. That's all that needs to be said. I'll buy it too. Number 4, confusing popular company with good investment. I see this one a lot. Just because a company has a great brand or it's a product that you really love or that you use or that you see all the time doesn't necessarily mean that it's going to be a great investment or a great stock. A company can have a great product, a great visibility, great reputation, but still be a bad investment. I know this seems counterintuitive, but that could be for a lot of reasons. It could be because the valuation is too high. The stock price is just already out of line with the actual value of the company. It could be because of competition and they're just in a space where they could easily be gobbled up or have market share taken away from them in a quick way. It could be because of bad financials. It could be for a variety of reasons. Let me give you a great example. Back in the 2010s, GoPro, the camera company, became massively popular. I mean, tons of people were buying GoPros, and you would have thought at the time, well, GoPro would be a great stock to buy. Look at how popular their product is. But their stock tanked because they had trouble creating recurring revenue, because once you buy a GoPro unit, well, okay, you're not paying monthly for it. You just buy it one time, and they didn't really have any other products where they could have a consistent revenue on a regular basis. But really the thing that was their downfall was smartphones just kept getting so much better. So the need for people to buy a separate camera other than their phone just continued to dwindle. And GoPros are still a great product, but their stock was just not in line with what people thought it was just a few years ago. And then number 5, and this is another really big one, believing that election results are a leading driver of market performance. Something to the effect of, if my candidate loses, the stock market's going to crash. If my candidate wins, the stock market's going to do great. We see this all the time, especially around the presidential election every 4 years. Markets react to policies, not personalities. When Donald Trump was elected here, end of 2024, there was a slight market bump because the market anticipated maybe some lower income tax rates and maybe a lowering of some regulations. But interestingly enough, in the weeks and months since, the market has reacted mostly negatively because of what? Not Trump's personality, but because of his policies, specifically his policy about tariffs. Well, tariffs are going to lead to higher prices, and it's going to lead to more competition, and it's going to throw a wrench in the works of a lot of economies, including the U.S. economy, at least in the short term. So the market reacted negatively, right? So it's never as simple as, Republican good, Democrat bad. Democrat good, Republican bad, and that's all you need to know as far as the direction of the market. That's never been the case. The market has consistently gone up over time with Republicans, with Democrats, with every combination. We've talked about this before. And there are so many other economic factors at play here. Inflation and global trade and interest rates. And these all have a bigger influence than just who happens to be sitting in the White House or in Congress at that moment. And you just look back a few years ago. There were a lot of people when Trump won back in 2016 that were freaked out. They thought market's going to crash. Oh no, this guy's going to mess everything up. And the market rallied and did incredibly well. And then when Biden won in 2020, same story, right? Oh no, Biden's going to be terrible for the market. It's going to crash. Well, of course we had COVID and the market tanked because of COVID. But then it rebounded very quickly, and you look at how the market did over those 4 years of Trump, 4 years of Biden, and it did just fine, right? So we like to chalk up movements in the market due to political parties or leaders when they are just a small, I'm not saying they're not a factor, but they're a small factor of many factors that are going on. Now, this list, we could go on and on with examples. I'm going to keep it to those 5. The financial world is really like this big tangle of wires, right? It's hard to know how they all connect and where they all lead. And because it's complicated, it can be easier to just tell ourselves, like a plausible narrative. Like, I think this is kind of what's going on, and it makes sense, and see if this is the case, then that would make sense why this, and this is happening, right? It's a reasonable explanation of why thing 1, 2, or 3 are all happening together. But let me give you an example, just from a logic standpoint, as to how this can be taken to an extreme and why this doesn't always work. So let's take, for instance, 2 things that are happening, and I'm just throwing this out as an example. I'm not saying I don't know if this is actually the case, but let's say that in 2025, Stanley Cup sales are up, and in 2025, the stock market is also up. I'm talking about Stanley Cup, the drink carrier, not the hockey trophy, okay? Well, assuming those 2 things happened this year, we might want to say, that Stanley Cup sales being up is what led to a higher stock market return, right? That A caused B. The problem with that is that there's no real reason why Stanley Cup sales would cause the entire U.S. stock market to rise unless we are buying billions and billions of Stanley Cups, because that's a relatively small part of the economy. So that doesn't hold up. But if we tried to reverse that and say it the other way around, that also would be problematic and say, oh, well, the reason that Stanley Cup sales are up is because the stock market did so well this year. So that explains it. Well, I mean, maybe that's a little bit more logical because people might tend to spend a little bit more on discretionary items if they feel more financially secure. So if the stock market is up, that signals economic growth, and but that's still not a reason. People aren't saying, what's the S&P 500 up today? Oh, it's up 2%. Yeah, honey, go ahead. Let's buy the Stanley Cup. That's not really what's happening, right? So really what would be happening in that scenario is that there is some type of hidden factor behind the scenes that is influencing both A and B. And in this case, it would seem to be the likely culprit would be a strong economy, right? If both of those things happen this year, one is not causing the other or vice versa. It's that there is a hidden factor that is influencing both of these things to be happening at the same time. A strong economy means people have more disposable income, and they would buy more things that are not necessities but wants, like Stanley Cups. I guess it depends on who you ask whether a Stanley Cup is a necessity. And then a strong economy would also drive the price of stocks up. So the real driver of both trends is not Stanley Cups, it's overall economic cycle. And sometimes it's just totally spurious. It has nothing to do with each other. Like, the stock market gains are linked to the number of Nicolas Cage movies released each year. No, it's nothing to do with that, right? So this is why having an investment approach that's not reliant on short-term market data is really important. I think a lot of people think that that's the way to get an edge. They think that's the way to have one up on the market, to see how all the dots connect and be able to figure out what's coming next. Very, very difficult to do. And worse yet, we definitely don't want to invest based on a gut feeling, on our hunch, like we're in an old-timey detective movie. That's not a good winning strategy. Investing is complicated, it's messy, it's easy to get distracted or fooled by the breakneck speed of current events. So if you want to be a better investor, make sure that you avoid that correlation and causation mistake. And as always, thank you for listening to the podcast. Head over to the YouTube channel if you haven't already gone over there. We'd love for you to check out the videos that we have there and subscribe. I'm doing some short form videos on YouTube as well that, of course, I don't always post. That I don't post on the podcast. So I'm trying to do a little bit more on the YouTube page. So I hope you'll check that out if you're just normally a podcast listener. Okay, have a great day, and I'll see you on the next episode.